Iran just doubled down on closing down the Strait of Hormuz again, and we all know how critical that choke point is for oil, helium, sulfur, and really every major input for AI infrastructure. And moments like this have caused some stocks to just skyrocket because they're the most limited resources that are feeding AI. Look, this is the oldest pattern in the markets. When a critical resource gets squeezed, the people who are controlling it are the ones that are making all the money. During the California gold rush, thousands had packed up and rushed out west, and most of them just went broke. But the man who actually built his fortune wasn't even panning for gold, but selling denim pants and shovels to the people who were. And when the internet exploded in the 90s, everyone piled their money into Cisco. And of course they were right, but if you had bought at the absolute peak, then you waited more than 20 years just to break even. And the thing is, today is no different. Everyone is chasing nvidia, and I understand why. But in every one of those moments, the real money was never in the obvious play. It was in the companies that were sitting on top of the physical constraint. You know, the thing that the entire build-out can't move without. As of right now, artificial intelligence has about 9 of those types of constraints here in 2026. I've spent roughly the last week mapping out every single one of these, and I tried to find the dominant stock that was sitting on top of each one. So there happens to be about 9 choke points and 9 stocks. So let's go ahead and jump into the video. The first company is going to be Vistra Corp, and I want to start with a statement. 3,800 megawatts of contracted nuclear power for AI data centers. That happens to be double the nearest competitor. Vistra generates power from nuclear plants that are across Texas and the Midwest. And unlike regulated utilities, they operate in a deregulated market, which means that they can sign direct long-term contracts with hyperscalers at real market prices. Meta locked in 2 gigawatts in a 20-year deal, and Amazon Web Services signed a 1.2 gigawatt deal out of Texas, also for 20 years. And the thing is, those are not fixed price contracts. With Hormuz closed and natural gas prices starting to climb, nuclear's fixed cost structure means that every dollar of rising energy cost, they're going to expand Vistra's margin while everyone else's begins to shrink. That means that they have a win-win on revenue and margin both at the same time. In fact, their revenue grew 13% last year, and the company is guiding for a 22% EBITDA growth in 2026, as those contracts are just ramping up. And they happen to have a PEG ratio of a 1.3 that's already priced for some growth, but not for the upside I just spoke about. Now we're going to go ahead and move on to the next pick of Eaton Corporation, where transformer lead times right now are 128 to 144 weeks. Like if you do the math, that's nearly 3 years. And half of all planned US data center builds in 2026, they're already delayed or canceled simply because of this. Eaton happens to own the full chain that solves this problem. They've got the transformers, the switchgear, power distribution units, and the busway that moves electricity from the grid to every server rack that's inside. They happen to capture $3.4 million in revenue per megawatt of data center capacity that's installed. And they are the only company that owns every piece of that chain from end to end. Data center orders alone were up 200% in a single quarter because when a project finally does get grid access, Eaton is the first one they call. And their current backlog represents 11 years of installed capacity at 2025 build rates, which means the demand they are sitting on goes well beyond anything that this AI cycle alone can absorb. Their earnings per share has nearly doubled in just 4 years, and their free cash flow has nearly tripled over that same time period. And operating margin has expanded from around 14% in 2021 to 19% today, with the company already targeting 30% in its core data center segment in 2026. So it's a transformation that is far from finished. Now, I have to point out that one of the hottest sectors this year has been copper and gold. And that brings us to today's sponsor of US Gold Mining Inc., which is on the NASDAQ. They own the Whistler Project, a gold, copper, and a silver exploration and development opportunity just 100 miles from Anchorage, Alaska. And copper and silver are now officially on the US Critical Minerals list. Now, the Whistler Project just completed a preliminary economic assessment, or PEA, and the results? Estimated production of 2.7 million ounces of gold, almost 600 million pounds of copper, and nearly 6.6 million ounces of silver over nearly a 15-year mining life, averaging 246,000 gold equivalent ounces per year. At $3,200 per ounce gold, estimated payback of capital is at 2.1 years. But at current spot prices, that actually drops to just 1.2 years. That PEA covers just one of 3 gold copper deposits on the property, with 25 exploration targets still ahead. And nearly 80% of outstanding shares are tightly held by the parent company and its insiders. Please do your own due diligence on US gold mining and check out the link down in the description. Now I'm going to move on and talk about what gets my attention about this next company of Vertiv, and it's this. The latest NVIDIA AI racks pull 132 kilowatts of power, but a traditional server rack pulls in 10 to 15. That's nearly 10 times the load, and it broke every cooling system data centers had relied on for decades. Vertiv makes the power management and the liquid cooling infrastructure that goes inside a data center once electricity arrives. So UPS systems, power distribution units, and liquid cooling as one integrated system. In fact, in 2026, they are the only major player that owns all three under one single roof. Air cooling can't handle 132 kilowatts per rack. Liquid cooling is the only answer, and Vertiv is the company NVIDIA named as their preferred infrastructure provider for AI factories globally early this year. Earnings per share grew 199% last year, and the company is guiding for 30% revenue growth in 2026. They entered this year with $15 billion in committed backlog, which is more than a full year's worth of revenue already signed in orders. Now I'm going to move along to the next one on the list, which is Micron Technology, where every supplier of high bandwidth memory on the planet is completely sold out through 2026. All three of them, with waitlists running already into 2027. HBM memory is physically stacked on top of every NVIDIA AI chip, and the chip simply doesn't function without it. And there's only three companies that make it. SK Hynix at 62% of the global supply, Samsung at 17%, and Micron is at 21%. There is no fourth option, and there's no substitute. So when demand exceeds what three companies can possibly produce, the entire AI build-out is simply going to wait. And of course, there's a backstory that changes everything for Micron specifically, because the Hormuz closure, it's disrupting the helium exports out of Qatar, and it's tightening the chemical supply chains that semiconductor fabs depend on at scale. SK Hynix runs Korean fabs that import those particular inputs. Micron runs on US fabs with access to domestic helium reserves and domestic supply chains. So when Korean input costs begin to rise, Micron either gains market share because SK Hynix produces less, or the whole market's price expands because supply tightens even more. Either one of those outcomes improves Micron's position, and my expectation is that this plays out over the next 12 to 18 months as Korean input costs just begin to get priced in. Now, Micron's revenue grew 56% last year, and earnings per share expanded 175% in a single fiscal year. And here's the kicker, their PEG ratio is currently at a 0.25, which is absolutely crazy low because of the expected growth. And that is why they are the fastest growing company on this list. Now we're going to look at a company that you may not have heard of, and that's called Amkor Technologies, where chips on a wafer substrate, or CoWoS, demand is growing at 80% a year. But the supply is only growing at 50%. So as you can tell, there's a gap in the math, and it's not going to fix itself in 2026. For reference, CoWoS is the advanced packaging process that assembles every NVIDIA AI chip, bonding the compute die, the HBM memory, and the interconnects into a single high-density module. Without it, the chip can't be built. TSMC performs most of this work, but NVIDIA already controls over half of TSMC's CoWoS capacity, which means every other AI chip maker, think Broadcom, AMD, every custom ASIC builder, they're gonna need a second source. And lo and behold, Amkor is that second source. And their Arizona facility, funded in part by the CHIPS Act, sits directly adjacent to the TSMC's US fabs. Their advanced packaging business is expected to nearly triple this year alone, as that overflow demand begins to fall in their lap. Now we're gonna go ahead and move on to one of my favorites to pay attention to, which is Broadcom, where the company entered 2026 with $73 billion in signed AI orders, locking in 18 to 24 months of committed revenue with the 5 largest AI spenders in the world before the year even started. Broadcom's a little unique because they own 2 pieces of the networking silicon layer simultaneously. The first is custom AI accelerator design. When Google, Meta, Amazon, and Microsoft decided they needed chips optimized for their specific workloads rather than buying NVIDIA straight off the shelf, they went to Broadcom. So think Google's TPU, Meta's MTIA, and Amazon's Trainium are all co-designed with Broadcom's teams. That happens to give them 60 to 70% of the custom AI chip market. Now that second layer happens to be Ethernet switching, the fabric that connects every server within the data center. Now there's a battle between competing networking standards, and it's now settled. Open Ethernet 1 and Broadcom's Tomahawk 6 controls 80% of that market. So when a hyperscaler builds a million GPU cluster, Every GPU in it communicates through Broadcom silicon. AI happened to go from a footnote to $8 billion just last quarter, which is 43% of total revenue for Broadcom, and guidance is already up 27% for the next quarter. Now on to one of the most underappreciated plays on this list, which happens to be Marvell Technology. And the reason starts with a single number: 63 million 800G and higher optical transceivers shipping this year. It's a 2.6 times jump from last year alone, with Marvell chip inside every single one of them. That chip is an optical DSP. It's the processor that converts electrical signals from a server into light pulses traveling through the fiber. Right now, the market is a duopoly. You've got Marvell and you've got Broadcom, which means when 63 million transceivers are shipping, two companies are splitting that revenue, and Marvell holds the number one position. The reason every hyperscaler is moving to optical right now happens to be physics. At 224 gigabits per second signaling speeds, copper cable reaches less than 1 meter, and it consumes 30% of the cluster's total power. Optical, or photonics, cuts that by 70%. The data center industry does not get a choice here. They're going to have to make the shift. So look, 4 years ago, Marvell was an Ethernet chip company. Then they happened to spend $10 billion acquiring Inphi in 2021, and they built the optical silicon position completely from scratch. Earnings per share tripled in a single year on a business segment that barely even existed when that deal even closed. Now we're going to move on to the next one, which may surprise a few of you, and that's Southern Copper Corporation, which sits at the base of every AI data center. And the constraint is pretty straightforward: 27 to 33 tons of copper per megawatt of installed capacity, which means a single 100 megawatt hyperscale facility consumes more copper than most mid-sized city infrastructure projects all combined. Copper is inside of everything within a data center that is not silicon. The power distribution infrastructure, the cooling loops, the transformers, the bus bars, everything that all the other companies on this list are going to depend on in order to do their job. All of it depends on copper, and none of them have a substitute. Here's something of importance. The S&P Global is projecting a 330,000 ton deficit in 2026 alone, and that's widening to a 10 million ton shortfall by 2040. This is all happening as AI demand compounds on top of electrification and grid expansion. Southern Copper operates the largest reserve base of any publicly listed miner on Earth at 51.1 million tons, and they produce at 42 cents per pound net cash cost. Every other major producer happens to cost 5 times more than that. Their revenue nearly doubled over the past 5 years, while the company ran a 52% operating margin, which is essentially unheard of in the mining area. And now we're going to go ahead and round this out with Corning, where the constraint is one multiplier. AI data centers require 36 times more fiber than a traditional server rack, and lead times on ribbon fiber are already stretching past 60 weeks. Corning makes the optical fiber cable that connects every server, every switch, and every GPU cluster inside a data center. And every one of those 63 million optical transceivers that we just talked about with Marvell requires fiber to carry that signal. The photonics adoption that drives Marvell's growth is the same wave that drives fiber demand. It's just one layer deep within the stack. Corning operates the world's largest fiber cable plant in Hickory, North Carolina, and in January of this year, Meta signed a multi-year agreement worth up to $6 billion for fiber, cable, and connectivity supply, with new manufacturing expansion already under construction. Demand for fiber today is growing at 22 to 25% annually, but supply can only expand at 11 to 19%. New fiber preform capacity takes 18 to 24 months to come online, which means the gap, it's not going to close in 2026, and maybe not even in 2027. Their operating income doubled in a single year as the supply squeeze accelerated, and the hyperscaler segment of their optical business grew 61%. And the Meta deal has not even fully landed yet. Now, before I cover how I'm going to be investing in these AI choke points, if you're getting any value from my videos, please consider pressing the like button so my channel can continue to grow. So if I'm going to think about how to size these 9 positions, I'm not treating them all equally. I'm thinking in 3 different layers. To me, the first layer is the foundation. Think Vistra, Eaton, and Vertiv. These are the power and the cooling companies. Nothing in AI works without them. I'd plan to put 40% here because there's lower volatility, it's steady compounding, and the demand story doesn't depend on any one company winning the chip wars. Now, the second layer is the silicon stack. Micron, Amcor, Broadcom, and Marvell. This is where the highest upside lives over the next 5 years. The photonics transition, it's just in the beginning stages. Custom silicon is also accelerating, and HBM demand has no ceiling in sight. I'd be placing another 40% here, with Marvell and Broadcom as the conviction positions inside of that group. Now on to the third layer, which is the physical materials. That's Southern Copper and Corning. The supply deficits are real and they don't resolve quickly, but these are longer time horizons. It's more value-oriented plays, so I'm only going to put 20% of my money here. That's just the framework as I would lay it out, and of course a person doesn't need to own all 9, but if you're building a portfolio around AI infrastructure, these are the 9 choke points that I would want exposure to. As always, this is for educational purposes, and it's not financial advice. If you want the full breakdown with all the numbers, the slides, they're all shared on my Patreon. And as always, thank you so much for watching, and I'll see you next time.